What is LVR? Today we're going to go through one of the most common terms that are used in the home loan process. We're going to teach you everything you need to know about LVR, what it means, and how it can impact your home buying journey. All right, let's jump right in. Hey guys, before we get started, if you like this video, make sure you give it a thumbs up, it means a lot, and subscribe below. We'd love to see you back. So what is LVR? LVR is an acronym, and it just means loan to value ratio. Sometimes it's called LTV. It all means the same. LVR, or loan to value ratio, is represented as a percentage on the amount that you borrow against the property value. Now, the banks place a massive emphasis on the LVR when you're buying a property. They consider the lower an LVR, the lower your risk, and the more willing they're gonna wanna throw money at you.
Nice.
All right, before we keep going, let's talk about how it's calculated. Loan to value ratio is calculated by getting your loan amount and dividing it by your property value and then multiplying it by 100. Let's have a look at a real example of that. All right, so practically speaking, if you had a loan of 400,000, you were buying a property for 500,000. You get the 400 divided by 500 equals 0.8. Times it by 100 gets you to an LVR of 80%. Now, one question we get asked all the time is, do I use the purchase price or the valuation to calculate my LVR? It's a good question. Now, the lenders will typically use the lower value of the two. Now, we see this quite often. If you're buying a property off the plan or a brand new unit, maybe the property value has gone down from the purchase price. Or sometimes it can be the other way. The property values might have gone up. We saw it in Sydney, Melbourne over the last few years, where your property could be valued at $600,000, but the purchase price is $500,000. Now, the banks will use the lower value to calculate your loan to value ratio. So in that circumstance, it's going to be back to this example where they're going to use the $500,000 contract price to work out your LVR and therefore determine your risk. So in what circumstances can you use the higher value? So there is one caveat to what I just mentioned. There are some circumstances where the bank will use the higher value of the property, even though you might have signed a contract of sale for a lower value. So in this circumstance, you might have bought a property and paid 500 grand. Now the value from that point, it might be over 12 months and it's gone up. It could be worth 600,000. So when will the bank use the higher value? Ta-da! So the bank can totally use the higher value in the case where you might have bought a property off the plan. You might have signed a contract 3 years ago and the property market could have moved dramatically in that time. The bank will use the higher valuation if it's over 12 months. Awesome. The other way you can do it is if you're buying from a family member. So it could be a sort of advantageous settlement and the bank will consider a higher value because the family member might not want you to use the stamp duty. That can help you because then the LVR could be lower, meaning you're lower risk to the bank and it's happy days all around.
Sunday, Monday, happy days. Tuesday, Wednesday, happy days.
Now, how do you calculate LVR for refinance? The banks will generally get a full property valuation of your house or your investment property. They'll send someone out there that will look at what the property is worth. Now, we've got other videos which you can check out below on how to value a property. They'll look at recent sales, they'll look at what you paid, they'll look at how long you've owned the property, and even the general condition of the property to determine the property value. Now, remember, the banks can be a bit conservative when they're working out this value. If you think it might be worth $700,000 and a real estate agent has told you that, it could be worth that, but generally the banks are looking a bit in the rearview mirror. So their values might be a little bit lower. And ultimately the bank will use the property valuation to determine your LVR and determine how much you can borrow. So I guess a follow-on question to that is, do the banks always need to get a valuation to determine your LVR? And the answer to that is no, not really. It depends on a range of factors. If you've got an LVR of 80% or less, a lot of the banks will consider using a drive-by valuation, even a computer-based one, to see what the property value is worth. So you might not need to get someone out there going through your bedrooms and checking out your house. The second circumstance where the bank won't need a valuation to work out your LVR is if you've bought a property and it meets certain criteria. The banks may just use the contract of sale to determine the property's value and lend based off that. pretty cool. So what's a good LVR? It's not really a good question. The real question is what the maximum LVR you can get. Now, the banks are generally limited to a loan to value ratio of 95%. In other words, they want you to have at least 5% equity in a property. Now let's look at that in a real example. Now, if you have an LVR of 80% or above, you will pay lender's mortgage insurance. That's an insurance to cover the banks in case something goes wrong. Now, there are some professions that we can have mortgage insurance waived. If you want details on that, hit us up below and we can check out if you meet that criteria. Back to the example. If you're buying a place or refinancing for $500,000, at a 95% LVR, the maximum loan you could get, generally including mortgage insurance, is $475,000. So the banks do want to see some equity there just in case something goes wrong and they need to sell up. They generally won't borrow 100% without the help of a guarantor. Again, we've got a whole other video on that you can check out. All right, we need to add in that acronym because I feel like there's not enough 3-letter words that you use in day-to-day life. So LMI versus LVR. It's the ultimate showdown. LMI, like I mentioned, is a one-off fee. It stands for lender's mortgage insurance, and it's paid at settlement of your loan. You don't need to pay it every year, but you do need to carry it with the loan as long as you've got it. Now, the reason that you pay LMI or lender's mortgage insurance is ultimately to protect the bank. It allows you to buy a property when you've got less than a 20% deposit. In other words, your LVR or loan to value ratio is 80% or higher. Now, the LMI is there just to protect the bank, and really it's an insurance taken out on you as the borrower in case something goes wrong and the bank has to sell up and they're gonna lose money. It is one of those things that, like I said, you have to pay to get in there, but unless you've got a bigger deposit, it's the cost of doing business. So that's it for today, guys. Hope you liked the video. If you did, please give it a thumbs up or leave a comment below. We'd love to hear your ideas and suggestions. And if you've got any more questions, hit us up at huntergalloway.com.au.